For decades, governments believed currencies were symbols of national strength. Flags could fall, empires could shrink, but money, once backed by the authority of the state, was supposed to remain untouchable. Central banks existed to protect that belief. Politicians built entire careers on it, and ordinary citizens trusted it without question. Then, in September of 1992, that belief cracked, not because of war, not because of revolution, but because one investor looked at the British pound and realized something governments didn't even want to admit. It was lying about its own strength. To understand how a single man could force a major world power to surrender its currency policy in one day, you have to understand the fear that haunted Europe after World War II. The continent had been destroyed twice in one generation, not only by bombs and soldiers, but by unstable money. Hyperinflation in Germany had wiped out savings. Competitive devaluations had poisoned trade. Currencies had become weapons. After the war, European leaders became obsessed with stability. If money could be controlled, they believed politics would calm down, economies would cooperate, and another catastrophe could be avoided. By the late 20th century, this obsession turned into a project. European nations wanted to lock their currencies together, reducing volatility and preparing for something even bigger, a single shared currency. But before that dream could exist, they needed a system to force discipline. That system became known as the European Exchange Rate Mechanism. The ERM was simple in theory and brutal in practice. Each country agreed to keep its currency trading within a narrow range against stronger anchor currencies, especially the German Deutschmark. If a currency drifted to high or to low, the country's central bank was obligated to intervene. That meant spending reserves, raising interest rates, or both. The message was clear. If you joined, you surrendered flexibility in exchange for credibility. In 1990, Britain joined the ERM. Politically, it was framed as a sign of strength. Economically, it was a gamble. The British economy was not aligned with Germany's. Inflation was higher. Growth was weaker. Productivity lagged. But the pound was fixed at a level that assumed Britain could compete on equal footing. That assumption would become fatal. At first, the illusion held. Markets respected government commitments. Traders hesitated to challenge central banks. The Bank of England had a reputation. The British government projected confidence. Interest rates stayed high. Unemployment quietly rose, and pressure built beneath the surface. But financial stress doesn't announce itself with sirens. It accumulates silently, waiting for someone willing to question the narrative. That someone was George Soros. Soros didn't see markets as numbers on screens. He saw them as belief systems. He believed prices reflected not just facts, but collective psychology. And he believed that when governments pretended reality didn't matter, markets eventually forced a reckoning. By the early 1990s, Soros and his team at the Quantum Fund began studying the ERM closely. What they saw disturbed them. Germany had recently reunified. The process was expensive, inflationary, and politically sensitive. To control inflation, Germany kept interest rates high. That forced every ERM member to follow, whether their economies could handle it or not. Britain couldn't. High rates were choking growth. Mortgage holders were suffering. Businesses were collapsing, yet lowering rates would break ERM rules. Soros understood something critical. The British government was trapped. Defending the pound required policies. That damaged the economy. Abandoning the defense would destroy credibility. Either way, something had to give. This is where most investors hesitate. Betting against the government feels reckless. Central banks can print money. They can raise rates. They can change rules. But Soros understood the asymmetry. Governments could delay reality, but they couldn't eliminate it. And the longer they delayed, the more expensive defense became. Quietly, methodically, Soros began building a position. He borrowed pounds and sold them. Not millions, not hundreds of millions, not billions. The logic was simple. If the pound was forced to devalue or leave the ERM, buying it back later would be far cheaper. This wasn't an attack driven by malice. It was a conclusion drawn from arithmetic. As pressure mounted, other traders noticed. Currency markets are ecosystems. When one large player moves, ripples follow. Selling intensified. The pound drifted toward the lower edge of its allowed range. The Bank of England intervened, spending reserves to buy pounds. For a moment, it worked. But interventions don't remove doubt. They amplify it. September 16, 1990 arrived quietly. By morning, selling pressure was relentless. The Bank of England raised interest rates from 10% to 12%, then announced they would go to 15%. It was a signal meant to terrify speculators. Instead, it confirmed weakness. Rates that high would crush the economy. Traders understood the government was bluffing. Soros didn't blink. Billions more pounds were sold. The Bank of England burned through reserves. By afternoon, the truth became undeniable. The defense was unsustainable. Britain announced it was withdrawing from the ERM. The pound was allowed to float. It collapsed. Within hours, the value Britain had sworn to defend vanished. Markets repriced instantly. What governments had insisted was impossible happened in a single day. Soros closed his position. The profit was estimated at around $1 billion. The loss to British taxpayers was enormous, not just financially, but psychologically. But the real story doesn't end with profit or loss. It ends with a shift in power. Black Wednesday exposed a new reality. Markets were no longer passive observers of policy. They were participants. Central banks could be challenged. National pride could be priced. Belief itself had become tradable. For Britain, the humiliation forced reform. Monetary policy was reconsidered. Eventually, the Bank of England gained greater independence. Ironically, after leaving the ERM, Britain's economy recovered. Flexibility returned. Growth resumed. The pound stabilized on honest terms rather than artificial promises for the world. The lesson was darker. If one investor could break a currency, what protected the rest? Soros didn't break the pound out of hatred or ideology. He exposed a contradiction. And contradictions, when ignored long enough, don't resolve quietly. They snap. Money, at its core, is not metal or paper. It is trust organized at scale. When governments defend illusions instead of fundamentals, markets become judges. Not moral judges, mathematical ones. Black Wednesday wasn't a crime. It was a diagnosis. And it proved something that still terrifies policymakers today. Currencies don't collapse when people hate them. They collapse when people stop believing the story behind them. By the early 1990s, Britain was already standing on unstable ground. Even if most people couldn't see it yet, on the surface, the country looked disciplined. Inflation was being fought. Interest rates were high. Politicians spoke confidently about stability, but underneath, the British economy was trying to obey rules that didn't fit its reality. In 1990, the United Kingdom joined the European exchange rate mechanism. The idea sounded logical. European currencies would move within fixed bands against each other, creating stability and encouraging trade. Britain agreed to keep the pound within a narrow range against the German Deutschmark. If the pound weakened, the Bank of England would step in. If it strengthened too much, it would intervene again. The message to markets was clear. The pound was protected, but protection only works when the fundamentals agree with the promise. Germany, at that time, was dealing with reunification. Inflation pressures were high, and the Bundesbank responded by keeping interest rates elevated. Britain, on the other hand, was sliding toward recession. Businesses were struggling. Unemployment was rising. High interest rates were crushing borrowers and slowing growth. Yet Britain was forced to keep rates high to defend the pound's position inside the European system. This created a quiet contradiction. Britain needed lower rates to stimulate its economy, but it needed higher rates to maintain the illusion of currency strength. Markets noticed this tension long before politicians admitted it. George Soros was not looking for drama. He was looking for imbalance. Soros had spent decades studying how markets behave when policy collides with reality. His core belief was simple but dangerous. Markets are not always efficient, and governments often lie to themselves. When those lies become too expensive to maintain, they break. And when they break, they do so suddenly. By 1992, Soros and his team at Quantum Fund began analyzing Britain's position inside the ERM. They examined reserves, interest rate sustainability, political pressure, and economic growth. What they saw was not strength, it was delay. Britain was postponing an adjustment that would eventually become unavoidable. The pound was overvalued. Defending it required constant intervention, and the longer the defense continued, the more expensive it became. Here is the part many people misunderstand. Soros did not attack Britain out of hostility. He didn't wake up one day and decide to break the pound. He simply bet that the British government could not keep its promise forever. His trade was not emotional. It was mathematical. He began quietly building a massive short position against the pound. That meant borrowing pounds and selling them, expecting to buy them back later at a lower price. As selling pressure increased, the Bank of England responded exactly as expected. It spent billions of dollars in reserves to buy pounds and pushed interest rates higher, trying to signal strength. But markets don't respond to signals. They respond to sustainability. Every intervention made the situation worse. Higher interest rates damaged the economy further. Spending reserves signaled desperation. Traders around the world began to see the same imbalance Soros saw. Confidence started leaking out of the system. On September 16, 1992, the pressure reached its breaking point. That morning, Britain announced an emergency interest rate hike, then another. The message was clear: we will do whatever it takes, but the market had already decided. Selling intensified. Billions of pounds flooded the market within hours. By the end of the day, the British government made a historic admission: it could no longer defend the pound. Britain withdrew from the exchange rate mechanism. The currency collapsed. Interest rates were slashed. The illusion ended. George Soros reportedly made over $1 billion in profit. But the real story isn't about his money. It's about what was exposed. A modern nation with a central bank, political authority, and international backing was forced to surrender to market reality, not because markets are evil, but because promises cannot override fundamentals forever. Ironically, once Britain exited the ERM and allowed the pound to flow freely, the economy began to recover. Lower interest rates helped businesses. Growth returned. The system healed only after the constraint was removed. Soros didn't destroy Britain. He accelerated a correction that was already overdue. And that's the uncomfortable truth behind financial power. Markets don't punish weakness. They punish denial. What happened to the British pound in 1992 wasn't an accident. It was a warning. When governments attempt to control prices, currencies, or interest rates without economic support, they create targets, not for villains, but for reality. In the next chapter, we'll look at what this moment changed forever, how central banks quietly rewrote their playbooks, why modern currency crises look different today, and why the same pattern keeps repeating from Asia to Europe to America, de-use with new names and larger numbers. By the time the British government realized what was happening, the damage was already irreversible. Currency markets moved faster than press conferences, faster than emergency meetings, and faster than political pride. For weeks, maybe months, pressure had been building quietly beneath the surface. Traders around the world could see it. The British pound was trapped inside a system that no longer reflected economic reality, and one man was willing to act on that truth when others hesitated. On the morning of September 16th, 1992, the Bank of England woke up to a full-scale assault on its currency. Billions of pounds were being sold every hour, not by panicked citizens, not by foreign governments, but by financial institutions and hedge funds executing cold, calculated trades. At the center of that storm was George Soros. Soros was not acting on instinct or emotion. He was acting on a structural imbalance. Britain had locked its currency into the European exchange rate mechanism, promising to keep the pound within a fixed range against the German mark. But Germany's economy was strong, disciplined, and inflation-resistant. Britain's was not. High interest rates were crushing growth. Inflation pressures were mounting. The peg was political, not economic. Soros understood a simple truth most leaders refuse to accept. A currency cannot be defended forever if the fundamentals are broken. No central bank, no matter how powerful, can outspend the global market indefinitely. And Soros didn't need to destroy the pound. He only needed to expose the lie holding it together. As selling intensified, the Bank of England responded the only way it knew how. It raised interest rates, first slightly, then aggressively. The idea was to make holding the pound more attractive, to scare traders into backing off. Instead, it confirmed their worst fears. Higher rates meant deeper economic pain. It meant the system was cracking. Then came the moment of desperation. Britain announced it would spend billions of pounds from its reserves to buy its own currency, trying to prop up the exchange rate. To the public, this looked like strength. To the markets, it looked like surrender disguised as confidence. Soros and others increased their bets. This was not personal. This was not an attack on Britain as a nation. It was an attack on an idea. The idea that political promises could override economic reality. Soros later explained that when he saw policymakers defending a position that could not mathematically hold, he felt morally justified betting against it. In his mind, the system was already broken. He was simply revealing it. By the afternoon, the pressure became unbearable. The Bank of England had burned through reserves at an alarming rate. Interest rates were raised again, this time to levels that threatened to choke the economy entirely. Still, the pound kept falling. The TE market was larger, faster, relentless, and then, quietly, without ceremony, the British government gave up. Britain withdrew from the exchange rate mechanism. The pound was allowed to float freely. Within hours, it collapsed in value. The consequences were immediate and historic. The UK government lost billions in a single day. Public confidence in economic leadership was shattered. A system defended with pride for years had fallen in less than 24 hours. And George Soros walked away with a profit estimated at over $1 billion. The headlines called him the man who broke the Bank of England. But that phrase misses the deeper truth. Soros did not break the pound. He revealed what was already broken. In the months that followed, something unexpected happened. Britain's economy began to recover. Freed from the artificial constraints of the exchange rate mechanism, exports became more competitive. Growth slowly returned. Interest rates fell. In a painful irony, the crisis that humiliated policymakers ended up benefiting the economy long-term. But the psychological damage lingered. Governments around the world learned a hard lesson that day. Markets are not emotional. They are not patriotic. They do not care about speeches or intentions. They respond to incentives, mathematics, and credibility. When those collapse, belief collapses with them. For Soros, the event became legendary, but it was never repeated in the same way. Not because he stopped seeing opportunities, but because central banks changed their behavior. They became more transparent, more cautious, more aware that credibility is a finite resource. Black Wednesday marked the moment when financial markets proved they could overpower sovereign governments without firing a single shot. No tanks, no sanctions, just capital, moving at the speed of belief. And that is the real legacy of that day. It wasn't about one man making $1 billion. It was about the modern financial world revealing its true hierarchy. Governments issue currencies. Central banks manage them, but markets decide whether they are believed. When belief disappears, even the strongest institutions are exposed. This is why currency crises still matter today. This is why traders watch central banks more closely than politicians. And this is why the question raised in 1992 still haunts global finance. What happens when the world stops believing? That story didn't end with the British pound. It became the blueprint for every major financial crisis that followed. And we are still living inside its shadow.